All right, let's get into it. If you're tired of just, throwing money at things and hoping for the best, and you're ready to actually build some real lasting wealth, well, you're in exactly the right place. In this explainer, we're not just going to talk about investing. We're going to build your personal investment blueprint, a real, solid plan for your financial future. So, let's get started. I want you to think about this for a second. Is your portfolio, right now, built on a carefully designed plan? Or is it more of a random collection of things you heard about on the news or from a friend, a hot tip here, a headline there? The difference between those two approaches is, well, it's everything. Today, we're giving you the architectural plans to build something that's actually designed to last. And that right there, that's the big idea for today. We're going to shift our entire mindset. We're moving away from making these speculative bets, and instead, we're going to start methodically constructing a portfolio. It's all about going from being a gambler, kind of hoping the market goes your way, to becoming the architect of your own financial future. Now look, you wouldn't build a skyscraper without first digging deep and pouring a massive, solid foundation, right? Of course not. Well, the exact same principle applies to investing. Rushing this first step is, frankly, a recipe for total disaster. So what does this essential groundwork actually look like?
Okay, these are the 4 pillars. They are absolutely non-negotiable. First up, you have to know your numbers. That means a brutally honest look at your net worth, what you own versus what you owe, and your cash flow. Second, an emergency fund. This is your financial shock absorber, because life is always going to throw you curveballs. Third, insurance. This protects you and your family from those huge, catastrophic events that could just wipe out your entire plan. And finally, you got to get that high-cost debt under control. Credit card debt is like building on quicksand. It'll sink your portfolio before you even get started.
And here's a huge one. You have to be really, really honest with yourself here. What's your real risk tolerance? I'm not talking about what you think you can handle when things are going great. I mean, could you watch your portfolio drop by 30% and not completely panic and sell everything? You need to know that about yourself before you put your money on the line. This is all about making sure your plan is something you can actually stick with for the long haul. We're talking at least 5 to 10 years. All right. With that foundation properly poured, we can finally move on to the fun part, the design phase. This is where we start drafting the actual architectural plans for your portfolio. We're going to get specific, define our goals, and choose our building materials, which are the different asset classes we're going to use. A good plan always starts with clear, measurable targets. So you've got to ask yourself some serious questions. What return are you aiming for? What is the absolute biggest loss you can stomach? Your max drawdown? How long are you investing for each specific goal? And how much of your money needs to be available quickly? Answering these questions turns these vague hopes you have into a concrete mission. Now let's look at a few sample blueprints you could use. First up, we have the conservative model. You can see it's heavy on debt, 60%. This whole allocation is about protecting your capital first and foremost, not chasing crazy high returns. It's built for stability, perfect for someone who really doesn't like risk or has a shorter time frame.
Next, we've got the moderate, or, the balanced approach. Here, we've dialed up the equity quite a bit, to 55%. This is a classic middle-of-the-road strategy. It's aiming for that steady, long-term growth without going too wild on the risk. You could say this is the workhorse portfolio for a lot of long-term investors.
And then for those of you who have a really long time horizon and a high tolerance for seeing big swings in your portfolio, we have the aggressive template. At 70% equity, the potential for higher returns is way, way bigger. But, and this is a big but, so is the potential for much larger drops. This is a blueprint for someone who really gets the risks involved and is laser-focused on maximum growth over many, many years. So you've picked a design that you think works for you. Great. But let me ask you this. Would you get on a brand new airplane that has never been tested in a simulator? No way, right? That's exactly why this next step is so important. We have to put our financial blueprint through a serious stress test before we commit our hard-earned money to it. This process is called backtesting, and it's basically a time machine for your portfolio. We take your chosen allocation, your rules, and we run it against decades of past market data. Now, the goal here isn't just to see how much money you could have made. More importantly, it's to understand the risks and see exactly how your portfolio would have behaved during the absolute worst of times. A backtest forces you to look at the ugly parts of history. It shows you in black and white how your chosen blueprint would have fared during a nightmare scenario, like the 2008 financial crisis or the COVID crash in 2020. Seeing a 30 or 40% loss on a chart is one thing, but you have to ask yourself, would I have panicked? Would I have sold at the very bottom? This is the ultimate test of whether your design is actually survivable for you.
Okay, the foundation is set. The plan is designed. It's been stress tested. Now it is time for the final and honestly maybe the most important phase, actually doing it and sticking with it. This is where discipline turns that blueprint on paper into a real wealth-generating structure.
Here is an incredibly powerful strategy for staying disciplined over the long run. Split your money into two separate buckets. The vast majority, 80 to 95%, goes into your core portfolio. This is your foundation. It's built for stability, and you just feed it automatically through SIPs. The small remaining part, 5 to 20%, goes into a separate account called an alpha sleeve. This is your workshop, your lab. It's where you can play with high-risk experimental ideas. This separation is so important because it protects your core foundation from your own brilliant but potentially terrible new ideas. The real path to success here is paved with systems, not with your emotions. You have to automate your contributions with SIPs. Just set it and forget it. Review your plan maybe once a year, not every single day. And most importantly, you have to build the discipline to just tune out all the market noise that is constantly trying to tempt you to abandon your blueprint. So let's do one final blueprint check, a pre-flight checklist before you invest a single rupee. Run through this list. Are your foundations secure? Check. Are your goals clearly defined? Check. Is your allocation chosen and stress tested? Check. Do you have a clear plan for how to implement it, including that separate alpha sleeve? And this last one is critical. Have you made a written pact with your future self that you will not override the system just because you get scared or greedy? And that really leaves us with the final and most important question of all. Look, having the perfect blueprint is one thing, but having the behavioral discipline to actually follow it year after year through the good times and the bad, well, that's what actually builds wealth. The plan is on the paper. The real work starts now.